The real estate market is volatile. One day, everything looks to be on the upswing, with prices surging and lending requirements loosening. But conditions may shift suddenly, and a shift may be on the horizon. Rising borrowing rates, increased inventories, and slow sales are all indicators of an impending disaster. What is going to happen? Will we see another recession? Is the housing crash over? Make sure to stay with us till the end to find out. There are varying predictions about the future of the U.S. housing market in 2023. Although some experts predict a more stable market, others worry that the market will soon fall or collapse. There is widespread concern that the nation may soon enter a recession as inflation soars. Several experts in the field of real estate, however, disagree that the current housing market represents a bubble or poses a serious risk to the already fragile economy. The biggest economic disaster in recent history was triggered by the housing market. Many newly built homes sat idle, and millions more Americans found themselves unexpectedly underwater as a result of the collapse of the subprime mortgage industry. Although the housing industry did face challenges during the 20th century, none of them, except for the Great Depression of 1929, contributed to the decline in property prices that occurred during the Great Recession of 2007. Keep in mind that not all recessions have a negative effect on the housing market. The housing market and demand were surprisingly resilient during the crisis of 2001. There have been a number of significant challenges to the housing market over the course of the last century, but none have resulted in a decline in home prices as compared to the Great Recession of 2007 and 2009. There are similarities between the current housing market boom and the last one, with its soaring prices, bidding wars, and a flood of investors. The majority of experts in the real estate industry are optimistic that this time the housing market won't collapse and a recession might not occur. Along with this, they also think that it may even help the nation recover. Loans that ballooned in size or were designed for borrowers to default have been met with action by the mortgage industry. Mortgages may now be approved only for buyers with stable and documented incomes. The outcome is far safer financing than the subprime lending that characterized the Great Recession of 2005 and 2007. Several troubled mortgages have been wiped off, and credit institutions are now more selective in who they will lend to. The housing scarcity is at an all-time high, with many more people looking for homes for sale or rent than there are homes to go around. With mortgage rates increasing and house affordability decreasing, annual home price rise slowed in 2022. Mortgage rates are expected to be high for the foreseeable future, which will lead to a drop in housing values. Nonetheless, economists predict that the recession, if it develops at all, would be mild and short-lived, unlike the Great Recession. Fewer homeowners will fail on their mortgages as a result, and those who are having trouble may choose to sell and recover some of their investments. As mortgage interest rates climb beyond 5% and approach 6%, many already strapped homeowners are taking a back seat. There are some who aren't getting the mortgages they need, others who can't afford the new rates and costs, and those who are waiting it out in case the economy takes a turn for the worst. Less real estate is changing hands, and the frequency with which buyers offer more than the asking price has dropped. Several people trying to sell their homes have had to lower their prices. It is expected that mortgage rates would fall in the case of a recession, which will encourage purchasers who did not lose their employment to return to the market. Sales of homes will rise as a result, which is good news for the economy as a whole. When the economy is in a downturn, the property market may help the country recover. There will be shifts in the U.S. housing market in 2023, but experts do not expect it to implode or cause a recession. To avoid a recurrence of the Great Recession, the mortgage industry has adopted measures to get rid of poor loans. Most Americans are hoping to avoid another 18 months of struggle due to the acute housing scarcity. Even if the economy is in a slump, rising house sales might help the country get back on its feet. When could the housing market crash? Real estate businesses and experts are having a tough time predicting the future of the housing market as it struggles to respond to record-high inflation and increased interest rates. It is necessary to get an understanding of the factors that lead to declines in real estate markets. Housing markets do not abruptly collapse, which is the first thing to keep in mind. A market's ultimate collapse is the result of several factors acting together. A housing bubble develops when there is an unnatural increase in property prices. The price may go up if there is a greater demand and more people are able to afford it. Prices also tend to rise when there is more demand than supply for a product or service. When the pressure from a growing property bubble increases, the market for homes might see a meltdown. When interest rates are raised, economic growth is hindered. Demand and employment might fall. When there is an excess of goods, prices tend to drop to attract more buyers. This might lead to a decline or a halt in the housing market. You can't possibly know how quickly things will improve or how much worse they can get. If the downturn is significant enough, it will rely on how sustainable growth was before it. The housing market continues to raise many worries. One of the primary factors in home price rise has been a chronic shortage of available homes. Along with this, rising interest rates have also discouraged both would-be sellers and builders from entering the market. Hence, there is little hope for a sustainable housing market or an increase in housing inventory very soon. National housing prices in the United States, including those from foreclosures, jumped 8.6% in November 2022 compared to the same month in 2021. In November 2022, housing prices were down 0.2% from the previous month on a monthly basis. According to the CoreLogic HPI prediction, house prices will drop by 2.8% by November 2023. Although house prices in 16 states increased by double digits, growth is slowing in several of the nation's most desirable housing regions. The southeastern states had the highest price rises as well as the greatest cooling. Bellingham is at extremely high risk, where there is almost a 70% chance of a decrease in house values over the next 12 months, according to the CoreLogic Market Risk Indicator, a monthly assessment of the general health of housing markets throughout the nation. There is also a strong probability of falling prices in the areas of Crestview, Fort Walton Beach, Destin, Florida, Salem, Oregon, Merced, California, and urban Honolulu, Hawaii. Using a multi-stage regression model, CoreLogic Market Risk Indicators assigns a probability score from 1 to 100 to each area based on the possibility of two scenarios, which are an increased 10% price reduction and a decreased 10% price reduction. A better score increases the possibility of a discounted purchase. Financial services giant Moody's Analytics is pessimistic about the future of the housing market, predicting a 4.9% decline in national house values between the third and fourth quarters of 2022 and 2023. If this happens, property values in the United States will fall by 10% from their all-time high. In spite of this, we may anticipate a wide range of outcomes due to differences in housing markets and communities. Home prices are predicted to fall by at least 5% in 178 out of the 322 areas evaluated by Moody's. Morristown, Tennessee, Pocatello, Idaho, Muskegon, Michigan, Boise, and Santa Cruz, California, are all examples of such marketplaces. These markets are vulnerable because price changes during the epidemic housing bubble were excessively large in relation to intrinsic worth. Moody's Analytics chief economist, Mark Zandi, notes that the quick price rise during the epidemic means that pricing in these marketplaces is less sticky than they have been in the past. In order to make a quick sale, sellers in these marketplaces are prepared to drastically reduce their asking prices. Home prices in Baltimore and Chicago, on the other hand, are predicted to fall by just 2.3% and 2.6%, respectively. The projected severity of the correction is lower in these markets, since they are not grossly overpriced. The housing market's long-term outlook remains cloudy. As citizens and stakeholders, it is our responsibility to think things through and make confident decisions to get through these tough times. That's all for today, guys. If you like this video, make sure to hit that thumbs up, subscribe to the channel, and press the bell icon for any new updates. See you in the next one.